If you own real property or plan to pass real property to your children or your beneficiaries, there is one concept that can have a massive impact on taxes. It's called step-up in basis. A lot of people have never heard of it, but it can save your family tens or even hundreds of thousands of dollars in taxes. And in some cases, making the wrong move can cause you to lose that benefit completely. So today I want to explain what step-up in basis is, how it works, and why it matters when you are planning your estate. To understand step-up in basis, we first need to talk about what basis means. Your basis is essentially what you paid for a real property. It is the starting point used to calculate capital gains tax if you were to go to sell. Let's say you bought a home for $300,000. Over time, the value increases to $1 million. If you sell that property during your lifetime, the difference between those numbers is considered a gain, and that gain may be subject to capital gains taxes. Now, here is where step-up in basis comes in. When someone passes away and their property is transferred to their beneficiaries, the beneficiary's basis is adjusted to the current fair market value at the time of death. So instead of using the original purchase price, the new basis is the updated value to the fair market value the day you died. Let's go back to that example. The property was purchased for $300,000. At the time of death, it is worth $1 million. With a step up in basis, the new basis becomes $1 million. So if the beneficiary sells the property at that value, there may be little or no capital gains tax. This is one of the most significant tax benefits in estate planning, one of the few benefits of debt, because it can dramatically reduce the tax burden on inherited property. For families with real estate, this can make a huge difference in preserving wealth. One of the biggest mistakes I see is when people transfer property during their lifetime without understanding this concept. For example, adding a child to the title or gifting the property early while you're still alive. When this happens, your basis gets carried over to them, which means the step up in basis is lost. And that can result in a much higher tax bill later on. This is why timing matters. Transferring property during your lifetime can have very different tax consequences compared to transferring it at death. In some cases, waiting can provide a much better outcome from a tax perspective. Step-up in basis should be considered as part of your overall estate planning strategy. It affects decisions like whether to transfer property now or later, how to structure ownership, and how to balance tax planning with other goals. Because estate planning is not just about who gets what. It is about how it is transferred and what the impact will be. If you own real property, here are a few important questions. What is your current basis compared to the fair market value today? Are you considering transferring property during your lifetime? And does your plan take advantage of step-up in basis? Because these decisions can have long-term consequences for your family. If you own real property and you want to make sure that your plan is structured properly, this is something worth reviewing. At Allenby Law, we help families understand how tax concepts like step-up in basis fit into their plan. We look at your assets, your goals, your options, so you can make informed decisions that protect your family. If you would like to review your situation or explore your options, you can reach out to us for a consultation. Because sometimes what you do not know can cost you the most.